James, thanks for joining us. How did the Harmony portfolios fare last month?
Well, November was a bit of a mixed month for the range, really, in the sense that there were quite large regional differentials between performance in the equity markets, and clearly the funds aren't immune from those kind of movements. So, of the 8, 4 were in positive territory, 4 unfortunately in negative territory over a very short time period. But looking over a more reasonable time period, 12 months, for example, all are in positive territory, as indeed they are over 5 years and since inception.
What were the main themes dominating markets last month?
Well, November was very much a month dominated by news flow over economic conditions, the subtext being, of course, when will QE start to be unwound in the US? And so the direction of the market really ebbed and flowed with sort of good or bad economic data out of the US. There were big differentials between markets in the equity market, for example, across the world in November. And again, it was a consequence of economic outlook, perhaps more than normal, and also what that meant in terms of what your central bank was likely to do. So US, UK, reasonably positive, certainly in positive territory over the month. Parts of Asia, particularly developed markets in Asia, were in negative territory, but Japan was actually the best performing developed market, which is again a particular niche monetary policy condition going on in Japan. Likewise, big differentials between the emerging markets and the developed markets. Emerging markets again in negative territory. So whereas developed markets up about 2% over the month, emerging markets down 1.5% over the month. And interestingly, it's worth bearing in mind again, here we are at the end of November, or the start of December when we're recording this, of course. Developed markets are up over 20% year to date, which is well in excess of what emerging markets have achieved.
Absolutely. How then did kind of market movements last month, how did that translate into returns in the portfolios?
Well, the Harmony funds were, as I said earlier, mixed in terms of some of the 8, 4 provided positive and 4 provided negative returns over the month. And again, the regional equity market performance, the local markets of these funds was particularly important to their performance. So the markets which tended to add value, the Harmony funds added value as well, and the ones where we saw negative returns from local equity markets, you saw a negative return from the Harmony funds. How the portfolios are positioned are neutral in equities. We've added a couple of months ago to emerging market equity. That underperformed over the month, so that was a drag on performance slightly. But we're underweight global government bonds. They had a pretty poor month, although again, there were quite big regional differentials between the bond markets. So Europe, for example, had a positive month. The European sovereign complex had a positive month. But generally, underweight global government bonds was a good thing in aggregate. Overweight investment grade, again, mixed in the sense that they were quite sensitive to their respective government bonds. So again, where the government bond added value, you'd have added value in investment grade, and likewise lost value if the sovereign has sold off. Further down the credit spectrum, though, you get less sensitivity and more carry and more value, perhaps, according to our models. Certainly, those parts of the market tended to experience positive absolute returns. So the lower end of the credit spectrum was quite beneficial to portfolios. Elsewhere, global property sold off again. It's underperformed developed markets pretty significantly year to date. We came into the year thinking it was expensive. We've been underweight for a decent amount of time, and again, that would have helped portfolios to be underweight global property. And then finally, looking elsewhere, commodities, for example, gold again lost value. I think largely a consequence of people pricing in an end to QE and perhaps reducing in their minds the risk of a sort of a dollar debasement, which is one of the main reasons people have been buying gold in portfolios recently.
A couple of things I just wanted to draw you on there. So emerging markets, first of all, big underperformance versus developed markets over, let's say, 12 months. That continued last month. What then is the opportunity there?
Well, our models have identified emerging markets as being quite cheap now. It does come with greater risk, though, so the key with emerging markets is always position sizing. When you're putting positions into a portfolio, two main elements that are important are the potential profit and your likelihood of achieving that profit. Now, emerging markets, we think there's a pretty good chance of achieving that profit, but it comes with a lot more volatility. The path is very winding, meandering, or perhaps worse. And so as a result, we don't have as big a position in emerging markets as you might think, given the potential profit, but we are a couple of percent overweight today.
And then very quickly, when you talk about global property, how are you able to access property in the portfolios?
Property securities really is the only way we can use property in the Harmony funds. They are liquid exposure to the listed property sector in the equity market. Direct bricks and mortar property have different characteristics. In the short term, they're much lower volatility, or at least the price is less discoverable, so it looks lower volatility. But over the long term, the volatility of the equity market drops out, and the returns patterns actually are quite similar between listed property and direct property.
James, did you elect to make any changes to the portfolios last month?
The main change we made in the Harmony portfolios over the last month came right at the end of the month, so it won't really have impacted performance in November, but clearly going forwards we expect it to. That's to add to a small position in emerging market debt, hard currency, so dollar denominated investment grade securities issued by governments in emerging markets. Our models suggest this is incredibly cheap today. It's the cheapest of all the fixed income markets available to us. It's very high quality, on the whole, and so it's not a riskless trade. Clearly, that you will suffer from the big sort of sentiment-based flows in and out of emerging market debt. But we think, from a purely valuation point of view, it's worth taking that short-term risk on in these portfolios. Elsewhere, we haven't made any major changes to the portfolios. We don't think now is necessarily the right time to be adding, particularly to the risk budget in the portfolios. Remember, the market's come a long way this year, and we think that a period of consolidation is probably due. So neutral equities, slight overweight to emerging markets, underweight government bonds, overweight parts of the credit market, added EMD in there, underweight to global property, but we mitigate that by having infrastructure positions, the securities we mentioned previously in podcasts, and then we were overweight cash. That's now been trimmed slightly to fund the MD position to roughly neutral.
Excellent. Final question, coming towards year end, what do you see going forwards, December and then on into 2014?
Well, December tends to be a slightly quieter month. I mean, clearly data and news flow continues, that doesn't go away, but the markets start to quieten down a little bit towards the end of the year. What we're anticipating in the short to medium term is we do think we will see a return of volatility. Volatility has been artificially low for the entirety of the year, really, and realised volatility in portfolios across the board, I think, will be lower than people would normally expect. And so this is not something we should get too accustomed to. We don't think it's a persistent characteristic of the market. It's much more likely to be a consequence of QE and these floods of artificial liquidity coming into the markets today. That will unwind at some point, and with it comes a lot of risk. I think we are in a world where there's reason to be confident, both in terms from a GDP point of view, from a corporate sector point of view, and potentially from a consumer point of view today. But we must remember that markets don't go up in a straight line. There are reasons still to be worried. A lot of tail risk perhaps have dissipated. The outlandish risks that people were worrying about a couple of years ago are less significant today, but they're replaced by new risks. And so it speaks to remaining diversified in portfolios. Don't have all your eggs in one basket. Make sure you have a variety of well-priced returns drivers in your portfolio today.
James, thank you very much for joining us.
Thanks, Richard.